market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the bond market sends the Fed chairman a clear message. We'll discuss the reaction with Katharine Neiss from PGIM Credit in just a moment. But there's also been another escalation in the Middle East. More on that shortly. Let's just kick off with what's been a bumper 24 hours for earnings, both in the U.S. and here in Europe. Our Charlie Wells is here with the latest. Hi, Charlie. So we're in the middle of tech earnings. The standout story, Samsung. What's happening there?
Well, Francine, Samsung really demonstrates the sort of compare and contrast dynamic that we've been seeing across this earnings season because they reported a 250-fold increase in chip profits and yet ended the day down. So if you just take a look at this chart, you can see over the past few days and on this past trading day in particular, the volatility that we've seen at Samsung despite stellar results and reports of strong demand ahead. Let's talk about two compare and contrast stories as well. That is Microsoft and Meta. You can take a look at this pre-market chart behind me. You see one red, one green. Well, that has a lot to do with earnings. You saw Meta reporting a disappointing revenue forecast for the months ahead and also capital expenditure that concerned investors, raising the lower end of their expected expenditure at this time when there were questions about AI spending. Different story, contrasting story with Microsoft, where you saw that cloud unit up 43%. So again, management there talking about keeping a lid on expenses. A real compare and contrast there, but that's not it for tech earnings. Let's look at what we've got coming ahead. We've got Apple and Amazon down the line. Now again, we're expecting to see revenue increased at Apple, up some 16% for Tim Cook's final full quarter as CEO. That's attributed to a lot of the iPhone growth that we've seen. Given that redesign, Amazon, all eyes are going to be on those web services. That is their main source of profit. And again, investors also asking questions, though, about expenditures.
Talk us through, Charlie, the flurry of European earnings that we've also had today.
Huge day here. Let's start with Shell because, of course, we know that they have been up significantly. Year to date, they're up over 23%. Now, they have benefited from a lot of volatility in the oil markets that we've seen, given that Middle East disruption. But they didn't get off scot-free, and they did report in their earnings disruptions because of their gas operations in the Gulf. So, again, one to watch there on Shell. But let's flip and take a look at AB InBev as well to see how they are performing in the markets because they reported softness. They are contending with some difficulties in China, some structural changes, consumers simply drinking less in this era when health concerns are top of mind. But we also saw a World Cup boost here. They saw some growth in the United States, in Mexico, on the back of the World Cup. World Cup theme, though, not boosting Adidas. Let's bring up Adidas because they reported a disappointing earnings release today. We're seeing them down significantly, down 17%. And what we're really hearing is investors latching on to World Cup marketing spend. That's just not translating to the sort of growth that investors really would have wanted to see there. Now, let's end on banks because it's been a very good time transatlantic to be a bank. And we're seeing that this morning. You see green from BBVA. You saw a surprise 2 million euro, as much as 2 million euro buyback from BBVA, and Societe Generale up as well, up about 1%, also announcing a buyback. But again, a little comparing contrast there. They didn't, Societe Generale, their trading desk, did not grow as much as a lot of competitors, but still in the green this morning.
Charlie, thanks so much. Charlie Wells there with the earnings wrap. Now, the U.S. has carried out a fresh wave of strikes against Iran that focused on military targets while stopping short of hitting bridges and power plants. So let's get more with Abir Abu Omar in Dubai. So, Abir, just talk us through the latest strikes and how much of an escalation is this?
Good morning, Francine. Quite an escalation this morning. The latest, perhaps, I would bring that to the table, is Iran just now reportedly hitting a Chinese company in Kuwait with one person there killed. We'll wait further details. But those tit-for-tat attacks seem to be returning to the region. That ceasefire, Francine, that was signed in September in Switzerland back in June seems to be out of the window. Now, that follows, as you can see on the screen there, it's Central Command in the United States saying that they've hit heavily, the last wave of attacks was heavily hitting Iran. They did not hit civilian infrastructure this time around. It was mostly military targets. And so you're seeing slightly a more measured round of attacks by both countries, but definitely further escalation in the Middle East with new fronts opening up.
So, Abir, what's the status of shipping through the Strait of Hormuz?
Yeah, that's what everyone's keeping an eye on, Francine. Brent above $90 a barrel. Movement there is still pretty much paralyzed. We're keeping an eye out on the ships that are trying to make their way there. We know that a Qatar LNG ship was able to make its way through the Strait of Hormuz with its lights open. It's been idling around the waterway for about 3 weeks. So that is positive, but in the midst of really negative news when it comes to ships and tankers in the waterway, because movement there is still pretty constrained, with ships unable to take the risk of crossing either the United States or Iran.
Abir, thank you so much. Abir Abu Omar there with the very latest. Now, Fed Chairman Kevin Warsh has insisted that policymakers' decisions to leave rates unchanged was not a sign of inertia at the central bank. Now, the BOE is also expected to hold later as it sticks to a wait-and-see approach to navigate the wild swings in oil and gas prices. With us now to talk through all of the details, Katharine Neiss, Deputy Head of Global Economics at PGIM Credit. Katharine, thank you for joining us. I mean, it's a huge week, actually, when you look at some of the market volatility. It's very clear that bond yields at 19-year high send us something. It's a warning signal for Kevin Warsh at the Fed. Like, does that challenge his expectations?
So I think it was a real surprise. I think a lot of people were expecting him to come out and give a strong performance at the press conference. And, you know, fairly or unfairly, the market has sort of judged this as you know, a weaker press conference than expected. And I think principally because there was an air gap between the rhetoric around commitment to price stability and, you know, an awareness that inflation has been away from the 2% target in the U.S. for really quite a long time, 5 years, and yet not taking it, looking like there was no appetite to surprise markets with what is, you know, not a very dramatic 25 basis point hike. Now, a charitable view of that would be, you know, that perhaps he's finding his feet a little bit like President Lagarde in the early days, you may recall. And now, you know, she's seen as quite a credible central banker. So I think, you know, clearly all is not lost, that perhaps he's falling more in the footsteps of an incremental approach, despite, you know, what he was talking about at the press conference. And I think for us, the view is still that hawkish tilt is going to come in September with 3 sequential hikes. But clearly there is a big risk here because it's got a whiff of discretionary monetary policy, which we know doesn't work. And the market could sort of bully him into doing, you know, perhaps even a 50 basis point hike. So I think that is the real risk here. Because,
Katharine, there's no doubt in your mind that that the Fed should deliver something faster.
From a pure, you know, economics perspective, I think it is a complete no-brainer that rates need to be higher in the U.S. And that is not something that is new this month in July. The writing has been on the wall for quite some time. I mean, the ECB, with a much weaker economy, with inflation at the target and inflation now really not that far above the target, they're already hiking, and markets have a very clear view around the ECB's reaction function. And because of the resurgence in you know, these tensions in the Middle East, you know, gave what, you know, had a, you know, quite a hawkish tone at their meeting. So we kind of know what to expect. And it does seem at odds a little bit with the messaging that we've had at the Fed. That I think people were expecting that to get put right, you know, yesterday.
People were expecting something yesterday, right? And there was a bit of repricing. So what do you do with Treasuries right now, especially the 30-year, which has moved quite a lot?
Well, as I said, you know, my base case will be that they will come out and do the right thing in terms of hiking rates and being very decisive in doing so. In you know, the next sequential meetings, and that by doing that, you know, that it will be vol dampening at the long end. But it's risky. It's risky, and it may be a bit of a painful path to get to that point. It may be that you know, we experience some volatility before we get there. But I think ultimately they will do the right thing and hike rates, and that they will double down on the commitment and put their money where their mouth is in terms of, being committed to the price stability target. But, as I say, the signal, it's confusing.
Yeah, I mean, just to be, you're very, very clear, but do you think it's the bond markets that will, continue to put pressure until that's achieved?
I think that is, one element of pressure, but there are other elements. And, Chairman Warsh, referenced this in the press conference. What about inflation expectations coming from households and businesses? We know that, energy prices feature significantly in headline inflation. People have a really high degree of awareness. You're filling up the tank in your car every week or every couple days. You know what that price is. You notice those price changes. Same with food prices. Food is very energy intensive. Plus, we've had, extremely unusual weather patterns that are affecting agricultural yields. That is something. So I think, and plus, we've had an experience of, exceptionally high inflation, just a few, in the recent past. So I think against that backdrop, there should be a concern amongst policymakers that inflation expectations are going to be a lot less sticky and more reactive to what's happening in the data. And that means that central banks need to move in order to demonstrate a commitment to getting things under control. And I think, that is the fear. And if that gets out from under you, then the risk is if you've got to act even more decisively down the line, which has, of course, a real economic cost to it.
What are you expecting from the Bank of England? Because, again, if you look at the ECB as a kind of template, right, on how to get inflation under handle, we should be expecting something today.
Yes, well, it's tricky. I mean, we do have to accept that policy rates in the UK are significantly higher than policy rates in the euro area, and yet our economies are very closely linked and not behaving in wildly different ways. Inflation is roughly in the same place. Growth is roughly in the same place. And yet we have much, much higher rates. And moreover, the trends in the latest data flow have been one of downside surprises on inflation, and even downside surprises on forward-looking elements of inflation like wage growth. And, the economy is actually, it's not falling through the floor. So I do think that the Bank of England can take its time, be on hold, that is credible. I agree with Skylar, who was on, just shortly before me when she said, that it's good for the Bank of England that the market is leaning hawkish. My own view is that actually when we get towards the end of the year, the Bank of England could well be in a position where they can actually cut rates. And again, it's not all at the doorstep of the Bank of England. We have a lot going on politically here in the UK that matters a lot for markets as well.
Which, of course, complicate things. But, when you look at the German 10-year bonds, they fared better than gilts. So how much of it is it the political situation, and how much of it is actually punishing the UK for this lack of, inflation discipline?
My sense, I mean, it's very difficult to prove this, empirically, but my sense is that quite a lot of this is now sitting on the doorstep of, political uncertainty ahead of this autumn budget. Yeah. I mean, the signals so far are reasonably positive. This change in leadership was less painful. It was smoother than we expected. We have a prime minister that is surrounded by people that the market has confidence in, etc. But, the difficult questions, the difficult trade-offs have not been addressed. No one really knows how that's going to resolve itself. We are paying the price for not having resolved those questions for quite some time. And people just want to see, they want to see action. Words alone are not enough. Actually, you've got to start doing something.
Katharine, great analysis. Katharine Neiss, Deputy Head of Global Economics at PGIM Credit. Coming up, a sales beat for Campari. We'll speak to the Chief Executive of drinks maker next. This is Bloomberg.
Today, 1 million The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts today at 12:30 p.m., only on Bloomberg.
Well, investors this morning cheering the results of Campari, which has reported sales for the first half that beat estimates. Now, the Italian drinks maker has been on a push to grow sales in the U.S., and we're delighted to be joined by Simon Hunt, the chief executive of the Campari Group. But Simon, thank you so much for joining us. So what's your first take on the ongoing summer season?
Yeah, I think, look, we've started the peak season very well, as you can see in our results. And I think that's, through Q2, we continued the momentum we had in the first quarter. And the big thing for us is just about staying true to the strategy that we've shared with everyone and being very clear about fewer, bigger bets. I think one of the best bits of commentary I saw this morning as I was just coming in was one of the analysts talking about fewer bets, better delivery. I think that's a very good summary of where we are.
So, I mean, when you look at, have you seen overall an increase or decrease depending on the geography and the heat waves? Again, are people consuming for the summer? Like, are they consuming alcohol differently because of the rising temperatures in Europe?
Yeah, I think, look, we track the weather like many companies, and the actual number of sunny days, which is really what we look for, is quite similar to last year. But you're right, the temperatures have definitely been higher. And what we see, though, in those occasions when people are out is they're looking for more refreshment cues. So we see more traditional cocktails under pressure, but actually our spritz portfolio, big glass of ice, very refreshing, even in hot climates or exceptional temperatures, does very well. I don't think it's been a big lift for us, but I think it's been positive.
What's been the U.S. like? I know in the past you were destocking in the U.S. That seems to be changing.
Yeah, again, we've continued now, and we will have delivered as a total business 5 quarters of consistent growth. And I think compared to our peers, that's a consistent delivery. And one of the big drivers on that is the US. And our performance in the US is we are investing behind our brands and we are gaining share in the most important channels. So, for example, at the moment, on Aperol, on Espolòn Tequila, and on Campari, we're growing double-digit in the on-premise. And that's where brands are built. And so for me, I'm really pleased with the performance. Yes, the market is tough, but gaining share now, I am confident the consumer will come back. Exactly when, as your previous commentator just said, we'll have to wait and see. But ultimately on this, gaining share now puts us in a very good position for that recovery.
Are you focusing on the two coasts, or have you also started penetrating markets in the middle of the U.S.?
Yeah, we operate nationally. I mean, we've prioritized the development of our spritz portfolio really on either sides of the coast, and then select markets in the middle of the states. But what we're seeing is broad growth across all of our states. And I think that's the encouraging part, where we talked about last time, consumers are looking for that moment, that conviviality, that social connection with their friends. And we create those moments. And as a result, we're seeing people really get behind that, whether you're in the Midwest, whether you're in Manhattan or LA.
I know there's been a talk, of course, and I think you mentioned it briefly, about the rollout of the Campari bottled spritz and the Aperol spritz in a bottle. How's that going specifically?
Yeah, I'm really pleased with this. It was one of the key tenets. What we'd worked out is consumers wanted to enjoy Aperol spritz or Asati spritz or Campari spritz in occasions that we couldn't offer it. So there are 2 key areas. One, we do a lot of work with music festivals, particularly in Europe. We run, I think, about 260 music festivals. We'd reached a point where we just couldn't meet the demand, where you couldn't make an Aperol spritz fast enough. So by moving to Aperol on tap, we've managed to unlock an occasion. And some of the initial results, we tested it last year, we've rolled it out this year, really, really encouraging. So far in Italy alone, we've taken about a 1.5% of share of premium beer, which for me is a massive opportunity for us as we look to expand those occasions into more beer occasions. So really positive on that side. We've also launched the Ready to Go. So if you're on a boat, you're up in the mountains, you're not somewhere where you can make a Aperol spritz, then we've got a Ready to Go can. And the initial launch on that, the velocity looks good in the key accounts. We've only in 4 markets in Europe so far, but if your listeners are traveling around on EasyJet or British Airways, you'll see it on those planes as well. So please enjoy it.
Simon, you said last year that you were pausing inorganic growth for the moment to actually focus on your top brands. Have you seen any opportunities to get back into M&A?
Yeah, I think you will have seen in the industry, there's a lot going on. There's a lot of speculation, CEO changes and restructures and mergers, and a lot of the commentary around the industry is quite busy. I think for us, we're just focusing on executing the plan we've got. We continue to look at anything that comes available, but at the moment, I'm not seeing bigger opportunities outside. Further down the line, there might be some opportunities that we could bring into the portfolio, but for now, we feel like we've got a significant opportunity with what we've got.
When you look at, the next couple of months or quarters, there's a lot of worry about geopolitics, inflation. Like, how do you see spending going forward? Are people deciding to drink and spend differently?
Yeah, as your previous commentator just talked about, the impact of inflation, and particularly when everyone's following the oil price daily, given the volatility there is a knock-on effect. For us, it's more short-term. It's in logistics, it's in insurance, it's in warehousing. So there are some cost pressures that we've reflected in our guidance in the second half to say, look, let's wait and see. It's still very volatile. But I think what we are seeing is even when the consumer is under pressure, which is what we've seen now for a number of years, and what I talk to about 2,500 bartenders or bar owners a year to give you an idea. And the consistent theme I hear from all of them is people are coming out, they still want to come out, they're just spending a bit less because they're feeling the pinch in their wallets.
Simon, if there's one thing in the next couple of months that you worry about, is that people are starting to feel a bit of pinch, so you have to make sure that maybe not focus on your margins so much, or is there something that we should be watching out for in terms of a change in behavior?
Yeah, not really. I mean, I think you're seeing a bit of tightening, but to be honest with you, this is not a news story. We hear about moderation. It's not a news story. And so I think what we're doing is we're just really executing the plan. We talked about last time, Campari has opportunities other companies don't have. We have a great portfolio that's now really focused. We've got a geographic expansion that you can see in our results. We're growing plus 9% in our developed markets, where we still have massive room to go. Convenience, tap, in can, getting share of new occasions we had. And then all of that tightened up with a better, tighter machine behind it is really where the team and I are focused. So I think that's where our effort goes. We're not too worried about what's happening around us. We still have a massive amount of share to go after. And the results you can see, we're gaining share in every one of the markets.
Simon, thank you so much for joining us today. Great pleasure to speak to you as ever. Simon Hunt, the Campari Group Chief Executive. Now, this is a picture across the board. If you look at some of the anxiousness that we're seeing out there, are certainly some of the questions that we need to focus on. So, look, U.S. stocks are rising. Microsoft is countering some of the bond rout that we're seeing. U.S. stocks, are rising on the strong growth at Microsoft, reassuring investors that expensive bets on AI are starting to pay off, outweighing resurgent worries about inflation. Microsoft jumping pre-market trading as its cloud unit grew at the fastest clip in 4 years, while the company also is holding the line on spending. Coming up, we'll discuss the construction outlook with the chief executive of building materials giant Heidelberg Materials. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Investors dump 30-year Treasury bonds, sending yields to a 19-year high on concerns that the Fed chair isn't fully committed to taming inflation. Tech earnings in focus. Microsoft jumps on surging cloud revenues, while Meta dips on a disappointing revenue outlook. In Korea, bumper chip profits are not enough to boost Samsung. And the U.S. launches new strikes against Iran, hitting dozens of military targets in return to Middle East escalation. Now, Poland says it's investigating an unidentified object that crashed on its territory close to the border with Ukraine during an intense Russian missile attack. Now, we understand that, Mr. Tusk saying the missile incident is serious, all points to a Russian ballistic missile. We haven't had confirmation on that yet, so we'll stay on top of it very, very closely. The Ukrainian foreign minister said a Russian Kh-101 cruise missile crossed into Poland. In a statement on the X platform, Poland Polish media reported that it was a Russian missile, citing a government source it did not identify. Now, the Bank of England is widely expected to leave interest rates on hold, sticking to a wait-and-see approach as it attempts to navigate fluctuations in energy prices sparked by the Iran war. Now, for more, let's bring in a Bloomberg Daybreak Europe anchor, Lizzie Burden, outside the Bank of England. Lizzie, what are we expecting from the BOE today?
Well, much like the Federal Reserve last night, Francine, a hawkish hold expected from the BOE today, with possibly a couple of dissents from the chief economist, Hugh Pill, external member Megan Green, maybe throw in Katharine Mann as well. But the reason that they'd want to take that wait-and-see approach is because things are uncertain on the geopolitical front, of course, when it comes to the Middle East war. We've seen those huge oil price swings in recent weeks, but also uncertain on the domestic front. We've got a new Prime Minister, Andy Burnham, of course, and maybe down the track they'll want to hike rates if there's a load of borrowing at the autumn budget. Now, the data recently gives them cover to hold. We had inflation dropping below the BOE's expectations to 2.6% in June, and therefore it looks like perhaps we'll have the guidance not changing at all since April. Bit of a copy and paste job expected by economists today.
Lizzie, thanks so much. Lizzie Burden there at the Bank of England. Now, viewers in the UK and Europe can watch our special coverage of the BOE decision and press conference from 12:30 p.m. at London time. You can also see it on the terminal, on Bloomberg.com and on YouTube. And then a little bit later, we'll also be speaking to Governor Andrew Bailey. Catch that conversation at 4:30 p.m. Now, Heidelberg Materials has narrowed its full-year profit guidance but expects demand in the construction sector to continue stabilizing. The German company is one of the world's biggest cement producers. It's described the environment as geopolitically and economically challenging. We're now joined by Dominik von Achten, the chief executive of Heidelberg Materials. Mr. von Achten, thank you so much for joining us. There's a lot going on in terms of risks and guidance. If you look at what you said for the forward guidance, what gives you the confidence that, you know, what we've seen this quarter marks a sustained demand recovery?
Yeah, Francine, thanks for having me. I think fantastic to be with you. There is a lot of volatility geopolitically and economically, but we target clearly to be the stable anchor in this. And that's why the growth momentum that we saw in the second quarter of 26 was very important for us, because it was comprised of two things. Organic growth for the first time, Francine, for the first time since more than 4 years, we have seen volume growth. That is really encouraging. And we top it up with some nice acquisitions that we've done in Canada, in the US, and also in Turkey.
So give us a sense of what regions you think will most likely drive volumes in the second half of the year.
Yeah, you know, we cover a lot of the world, so I can go from east to west. So Australia is coming back after a couple of dire straight years. We see volume growth in Australia. We see volume growth in our core markets in Asia. That's outside of China, mainly Indonesia and also India. There is growth in Africa, I think, especially also in Sub-Sahara Africa, East Africa. I think the growth is coming back. In Europe, growth is coming back in Northern Europe. Two important markets for us are Norway and Sweden. I would say your home country in the UK, together with Germany, Benelux, is still a little bit sluggish, but there is still good growth out of Eastern Europe and also Southern Europe. And then in the US, we had a tough first quarter, but you saw also our figures in the US. Revenues are up 5% in the US. So also the US is growing on the back of some very big projects that really drive the growth in the US.
But overall, I understand you've narrowed your guidance a touch. Is this due to better visibility, or is it because you're just more cautious in the second half of the year? And if you're more cautious, what is it exactly about?
It's clearly the first. It's it's just to be more precise. You know, the guidance had a pretty far gap, and that's something we usually do, that we then specify it. So I think we are absolutely confident for the second half to deliver this guidance. As we said, the demand signals are encouraging. We continue to do bolt-on acquisitions. You should see some additional movements here in the next couple of months also. So we are absolutely confident that we will deliver on this guidance.
So on your acquisitions, what parts of the world are a priority? What kind of companies are you looking at?
Yeah, important point, Francine. It's in the end bolt-on acquisitions in existing markets. Mostly, I think that's clearly our target. That's why we have moved on Turkey, because we know the assets for 35 years in a joint venture. We have stepped up into a majority position. We continue to do acquisitions in North America. We've just closed one in Edmonton, so west of Canada. We have done an acquisition in Texas, so the US will stay on the radar. But we are open for acquisitions in the parts of the world where we operate or where we currently trade. I think that's our clear focus.
Given everything that's going on in the Middle East with price action and the price of oil, when do you expect actually these energy and freight costs to come down?
Yeah, Francine, if I could give you that answer, I probably would be in a different job. But it's important for us because we are very energy intensive. So yes, that volatility will stay with us. I think we expect underlying energy costs to be still high because, you know, that's also when you talk coal, petcoke and other commodities, that's something that you can't turn on and off in just a couple of days. I think the diesel will need to fluctuate with what we see at the pump, basically. But the underlying energy costs will be high in the second half. But we are working and we are doing our homework. We've just done our 2.5 weeks of discussions with our management teams globally. We are working on the pricing side with surcharges. So we are very confident, again, that we will deliver on our guidance for the second half.
I was going to ask you about that. How much further pricing or fuel surcharges are you expecting to have to implement if energy costs stay elevated to protect your margins?
Well, I think if we stay at the current level or if we come down what we saw, for example, in end of June, beginning of July, I think we are moving in the right direction. But if we see others or more sustained spikes in energy and oil prices, I think we need to continue to implement surcharges and implement price increases. We are on it and we see good traction for the second half. The management teams are fired up to get it done. And I'm very confident that we will deliver on this.
I mean, going forward, how much of your future growth will come from infrastructure or data centers linked to AI, and how much of it will actually come from more traditional housing and infrastructure?
Yeah, I think right now, I think it's fair to say that the predominant amount of the growth comes from, what you mentioned, we call it industrial segment. So that's basically data center and AI, predominantly in the US, but also partially in Europe. And then also in infrastructure. You see big infrastructure projects in the US. You see big infrastructure projects in Europe coming. You know that Germany is up to spend a triple-digit billion number on infrastructure. So the projects are coming into the pipeline. Housing continues to be sluggish around the world. There is very little movement on housing. There is some stabilization. I think now in Germany, there's stabilization in Northern Europe on the housing side. And it very much depends on what you covered in your program before, what the interest rates are doing. And I don't have to talk to you. You're sitting in the UK, so you probably know what the Bank of England will decide will have an impact on whether the public in the UK goes back in building their own houses.
Yeah, that's the question that hopefully we'll have answered in just a couple of hours. Dominik van Achten, thank you so much for joining us. That was, of course, Chief Executive of Heidelberg Materials. Now, L'Oréal has also reported quarterly sales that beat expectations on the back of rising demand for hair care products. Well, I spoke exclusively to the Chief Executive, Nicolas Hieronimus, about the company's resilience.
Beauty is a very dynamic category, and it shows once again its resilience in times of trouble. We call it, whether you call it the lipstick effect or the dopamine effect of beauty. The market's growing. It has accelerated a bit in Q2, and people are going for innovation, for quality, and that's probably the reason behind our great first half at plus 6.5%, way above the market growth, is that we brought a lot of innovation and of superior quality into the market.
Is there a section of the market, because you're really exposed to some of the very high-end brands and some of the more mass market, is there a section of those that is actually doing better than expected?
Well, the overall, what's great this year is that, and that's probably the strength of our portfolio, the breadth of our portfolio, which goes from products at 4 or 5 euros to product at 300, is that all our divisions and brands are contributing. If I look at the top 4 brands that are contributing to my growth, you have L'Oréal Paris, you have Kérastase, you have La Roche-Posay and Yves Saint Laurent. So a luxury brand, a Dome brand, a mass market brand, and a professional brand. And that shows that you have to have beauty for everyone. Now, if you look at the categories or the type of products that are flying the most, you've got 2 categories that are really driving the growth: is hair care and fragrance. And as far as market is concerned, you continue to see dermatological beauty extremely dynamic because people want safe and efficacious product, which is what we provide with brands like La Roche-Posay or CeraVe, which are doing phenomenal in the beginning of the year.
Do your customers spend differently in the US than they do in Europe than they do in Asia?
Well, the markets are different. Asia is a skincare market. And the good thing about Asia is that it confirms that China is back to positive territory and is driven by luxury. So there's, I would say, a stronger appetite right now for premium in China. And our L'Oréal Luxe division is at +10 after 6 months in China, which is very positive. So China is more about skincare. The US has always been a very strong makeup market and remains so, but it's true there's been really an acceleration of hair care a lot in the US. Overall consumption is pretty good in the US. Consumers are pretty resilient. And then we see all around the world, the need for better skincare, for UV protection. And that's also an area where some of our brands thrive. We just launched CeraVe sun care, which is doing great too. So, but in the end, I think I know you're trying to find differences, but there's an overarching trends that people want beauty and want innovation. And, one of the things we've done at L'Oréal is that we've more than doubled the weight of innovation in our business between this first half and last year's first half, which is also why we are gaining market share, because consumers are constantly tempted by new ideas, new products. And you're right to mention influencers that play a very important role in bringing these new products to life on TikTok or other channels. And you have to be in that game and to be providing very exciting new products. And that's true all across the world, whether Asia, North America, or even the Middle East.
As you mentioned, a good set of results, but there is a lot of pressure economically and on geopolitics. What's the hardest thing that you have to navigate, either in terms of tariffs, inflation, or trade in general?
Well, what's clear is that you have to be agile and you have to be able to adapt, whether it's on tariffs, whether it's the price of oil, which has an impact on the cost of transportation, whether indeed it's the impact of the crisis in the Middle East on consumer behaviors as it relates to travel retail, for example. So it's a lot about agility. Of course, currencies also have an impact, and we are happy for L'Oréal that the dollar is a bit better than it used to be. So in the end, it's about seizing the ascending trends and trying to leverage what I think is unique at L'Oréal is the fact that we are very, very spread. We call that a multipolar model. We are spread across regions and across price points and divisions. So whenever something is struggling a bit, we can bounce back in another area. And if I take this first half, Middle East was below expectations, even though not as much as what we feared. But the fact that China, luxury in China is more positive kind of offsets it. So that's how we navigate. And in the end, going back to what I was saying earlier, I really see, it's not that I feel, I can observe that when the world's getting tougher, people are really more inclined to indulge in pleasurable beauty products. There are people that want more indulgence, others that want more health-related products, and we have both. So that's how we navigate this crazy world.
Well, that was the L'Oréal Chief Executive, Nicolas Hieronimus. Now, coming up, we go inside the uproar engulfing international football as FIFA looks to press ahead with controversial sale plans. That's coming up next, and this is Bloomberg. Polish Prime Minister Donald Tusk says an object that crashed near its border with Ukraine was a Russian missile. Well, Poland says the incident took place at 3:40 a.m. local time during an intense Russian attack targeting Ukraine. For more, we're joined by our Chief Europe correspondent, Oliver Crook. Oliver, this feels like a big deal. What do we actually know about this incident?
Yeah, absolutely, Francine. It's something we've been monitoring over the last couple of hours. As you say, overnight you had a massive barrage of missiles attacking Ukraine and also specifically the western part of Ukraine. Then there were reports that there had been an object that crossed into Polish territory. The Polish authorities were really waiting to see what that actually was. And it seems now that the Polish Prime Minister, Donald Tusk, is satisfied to say that this item was likely a Russian missile that crossed over into Polish airspace. Obviously, Francine, that's significant for a very great number of reasons, not least of which that Poland is, of course, a member of NATO. And you'll remember in the early months of the war, right after the war began back in 2022, there had been another missile that entered into Polish airspace, exploded there in Poland, but that was a Ukrainian air defense system. But at the time, nobody knew that. People were very concerned that this could have been a Russian infraction, and that will obviously bring into the fore this very important conversation about invoking potentially Article 5 of NATO. Now, that obviously did not happen, and we've had a number of Article 4 of NATO being triggered. That is a consultations over things that have been of concern. They happened very recently by the Poles when a number of Russian drones entered into the airspace. But we're watching it very carefully, Francine. We're going to see after the sort of crisis meeting over in Poland what we get from the Premier, how big a deal they want to make of this. But of course, another likely step could be that the Poles invoked Article 4 of NATO, which would be consultations on defense in order to figure out how to respond to this incident.
Yeah, it feels like very delicate times. Ollie, thanks so much. Oliver Crook, our Chief Europe correspondent. And of course, we'll be monitoring the situation very closely. Now, the insurance firm Munich Re is warning that the industry should be braced for losses tied to the fallout of this year's extreme heat waves. Now, much of the U.S. and Western Europe remains in a heat wave, with 2 firefighters dying tackling a wildfire in Greece. Now, for more, we're joined by Alistair Marsh, our climate change reporter. Alistair, I mean, if you look at the pictures, they're just absolutely incredible. And in many parts, they just can't get a handle of the wildfire. Yeah. So how serious does Munich Re say the situation is?
Well, Munich Re, as always, these reports are very grim reading. I mean, it's $112 billion of losses in the first half. That's all types of natural catastrophe. If you think about specifically the fires in France and Spain right now, insurers are only just starting to kind of come together with estimates of the size. We're talking about several hundred million euros as an estimate we have from Aon at this point. But interesting to note that of the 112 billion from Munich Re, only 44 billion is insured. And that's sort of the future that we might be looking at as we have El Nino and climate change. There may be some sectors and industries where insurers start to say, not so sure I want to be involved in that anymore.
Yeah, because actually if it's a natural disaster, then it's force majeure, and actually a lot of these, insurance and reinsurers won't pay up. Now, the firm scientists also say that the world is headed for a super El Nino.
Yes.
So what does that mean in terms of economic but political consequences?
Well, yeah, the super El Nino is, I guess, accelerating a natural phenomenon, but it's going to mean more losses, more fires, more extreme events of this sort. In fact, we've had scientists saying that next year there's some predictions that for the first time we'll have a monthly global temperature rise of above 2 degrees, which would be the first time ever. And all of that means disrupted weather patterns, fires, floods, and the like around the world, and cooling as well. It's not just some places being on fire, it'll be disrupting monsoon events, etc., which has obvious implications for commodities and the like.
I mean, do you see a change in how people are interpreting this or changing their habits, or is it just people, it feels like every year is a surprise, but we know what's happening to the climate?
Yeah, well, I think that there's a waking up, a realization especially amongst the investor community, that this is, regardless of the politics, these issues are not going away. And when you see France on fire, it's very obvious,
Yeah, Alistair, thank you so much. Alistair Marsh there with some great reporting, of course, on the wildfires. Bloomberg also understands that FIFA began secret talks over its plans to sell a stake in its new media division last year, meeting with Joshua Kushner, a venture capitalist with family ties to President Trump. Now, football's governing body is looking to secure its first ever private investment, raising as much as $4.2 billion. But the plans, we all know, have sparked a backlash, with Europe's Football Association saying said to be considering a boycott. Well, Bloomberg's Tiwa Adebayo has been following the story and joins us now. Tiwa, I mean, these are very controversial plans, to kind of put it diplomatically. Why so?
Well, it's controversial because it really goes to the heart of this issue that is concerning so many football fans around the world. The businessification, shall we say, of football, and many are worried that it will lose the essence of it as a sport. FIFA have tried to sort of assuage these concerns. They've said that the proposed company won't be under the control of investors. It will remain under the control of FIFA. But it's not been convincing. There have been some big critics from the EU, also new Prime Minister Andy Burnham criticising this as well. And for a lot of people, this hasn't just started with these plans. We've just seen the World Cup. There were huge concerns about the commercialisation of that as a tournament. It was the most profitable World Cup of all time for FIFA. So for many, this is the latest in a long line of incorrect actions that FIFA has taken.
I have to say, I was impressed by Andy Burnham. He was like straight in there, like faster than a lot of the football commentators. What hurdles could FIFA then face as it tries to get this deal done? I haven't even seen that much private equity, or investors being behind this.
Yeah, well, they are likely going to face hurdles from fans. There's going to be major backlash there. But also, we mentioned UEFA, who are in charge of European tournaments. They have come out very strongly saying that this deal crosses a line in football. They're talking about a boycott of FIFA events. But also what's important for FIFA, UEFA make up 55 of their associate members. And also it's UEFA who often give permission for players to go to FIFA tournaments during the international breaks. If that relationship does break down, it could make things very difficult for FIFA, who are in some respects dependent on UEFA.
I mean, how does, if you look, I don't know whether there are parallels with, what we saw with the Super League, or if you look at kind of other things that were so controversial. But, I mean, could this last? Could the controversy last for a long time? There's also a deadline, which is 30 days.
Well, if we look to parallels in other sports, we've seen with the PGA Tour in golf, that started in 2024. We're still talking about it now. So if that's anything to go by, this looks set to continue for a long time. But I don't think it will go away anytime soon, just because of how poignant it is for so many football fans and how anxious a lot of people are about where football is going, what hands it's going to be under. There are these concerns about the links with Trump. Of course, the company that is helping to raise this money, or will be helping to raise this money, is run by the brother of Trump's son-in-law. And there's concerns there as well. So there are likely many different angles that we'll continue to talk about when it comes to this deal.
Tiwa, thank you so much for the great briefing on FIFA. We're all hooked to see what happens next. Tiwa Adebayo. Now, this is a picture across the board. Now, we have a lot of earnings. Microsoft gaining as results seem to be showing strong cloud revenue. If you look at Meta, those shares actually falling pre-market after the Facebook parent raised the low end of its full-year forecast for both capital expenditures and total expenses. A couple of things we need to watch out for is, of course, what's happening with bond yields. I have to say investors definitely yesterday dumped those 30-year Treasury bonds, sending the yield up as much as 14 basis points to nearly 5.23% after the Fed kept interest rates unchanged for a seventh consecutive month. And then since S&P futures gaining 0.2%, but I do think that it's the market measuring these inflation expectations that are rising, the dollar sliding, and so the main focus today will probably be on the Fed and Treasuries again. Up next, Bloomberg Brief, and this is Bloomberg.